I'm going to go over why no one should ever buy covered call ETFs such as QYLD, XYLD, or RYLD. And I mean no one, even if you want those monthly dividends. And instead, I'm going to show you a simple strategy where you can get higher or the same monthly dividends, more capital appreciation, and pay lower taxes all at the same time. So how these covered call ETFs work is they own all the individual stocks of an index such as the NASDAQ 100 and the S&P 500. And then they sell a covered call 1 month out that's at the money. So if you're experienced with options, the flaw in this should become very apparent, that you are capping all your upside returns, but you're going to participate on all the downside. And this is going to set you up for the potential long-term loss on the ETF, such as we've seen with QYLD, which the chart below is showing. Since its inception in 2013, its shares have slowly depreciated over time. And this is also setting you up that your dividends can be lowered in the future. Another thing that affects the dividends, which most people don't realize, is the volatility in the market. When volatility is higher, options premium is higher, so your payouts are higher. And this is what people have seen for the last 2 years. But in other markets that are much slower, when the volatility contracts, your payouts can get much, much smaller. And on top of all of this, these aren't taxed as regular dividends that have reduced tax rate. They're taxed as regular income. So now for my superior strategy, which is very, very simple. All you have to do is buy any of the regular ETFs, such as the QQQ or the SPY, and you slowly sell shares to produce that monthly income. If you wait at least 1 year, anything you sell is also going to be taxed at long-term capital gains. You'll pay a lot less taxes. And if you wanted to reinvest, well, you can just choose not to sell the shares when the income isn't needed and let that capital appreciation happen. There's a near identical downside risk profile. And we've also now increased your potential returns by up to 2 times. So I have the sample results of how this, and I'll go over the Excel sheet, which I produced this later to show how it works. But basically, I've created the 3 different strategies, just holding the index itself, and then my superior strategy of holding the index and then slowly selling it off to create that income, and the covered call ETF itself. So you can see the results are very apparent. If you just hold the index itself, your total returns are going to be much greater, but your dividends are going to be lower. But if you want that same dividend yield and we slowly sell it off, we can recreate almost an identical dividend yield with a dramatically larger capital appreciation. So as you can see in the QYLD example, if we just had QYLD, we would have had total return since inception of $15,401 from the ending value and the total dividends. But if we held the QQQ and solely sold off shares, we would actually have a total return of almost $29,000. That's double the return, almost double the return of QYLD, and we got slightly higher dividends. So now I'm going to go over, if you want to see, in the Excel sheet to kind of show you how this works and how you can adjust this for your own needs. And don't forget to like, share, and subscribe. So here's the Excel sheet I created to model this simple strategy. It's very simple. We just look at the close value once a month and the amount of shares, which slowly goes down as we sell them to create the monthly dividend. So as you can see, to start this in our hypothetical $10,000 portfolio, we start with approximately 127 shares at a starting price of $78.72. And as we go along, we have to sell the shares little bit by little bit, so our shares get lower and lower to create this monthly dividend, which recreates the same amount that QYLD has received. And as this goes on, you'll see the shares are getting lower and lower, but the capital appreciation is going up. And because the share price is getting higher and higher, to create this same monthly dividend, the amount of shares we have to sell gets lower. And this is the primary reason this strategy heavily outperforms the covered call ETFs. So as you can see right now, how I have it set up, we have the exact ending values you saw in the previous slide. So we're going to go and adjust these to see how it works for different examples. So say you don't need as high monthly payout. So let's lower this to $50 a month or a 0.5% yield a month. So as you can see, we go down, down, down. Our shares are higher and the amount we have to sell is lower, and we've only received $5,150 in dividends, but our ending value is higher and our total value at the end is several $1,000s higher as well. And vice versa, if you want a higher monthly payout, we can also do that as well. So let's up this to 1.2% a month, or $120 a month for our $10,000 portfolio. And our shares are lower and the amount of shares we're selling is slightly higher to receive this, but now we receive 50% more total dividends. Our ending value is actually still much higher than QYLD as our total ending value, including the dividends as well. So I hope you've enjoyed this video. Remember to like, share, and subscribe, and never buy covered call ETFs.